Hey everyone, today we're diving deep into a topic that's on every investor's mind, the future of the stock market. We've seen an incredible bull run, especially with the S&P 500 hitting new highs. But what's next? Is a major correction looming, or are we just getting started? We'll break down the predictions for 2026 and beyond, explore key strategies for these uncertain times, and reveal the secret weapon shaping our financial future. Let's get into it. First up, let's talk about the big question. What's next after this historic bull run? The S&P 500 has been on an absolute tear, and it's natural to wonder if the party's about to end. Some experts are pointing to signs of an overextended market. They're looking at valuation metrics, like the price-to-earnings ratio, which are sitting well above historical averages. This leads to the concern, is the S&P 500 ready for a major correction? A correction, typically defined as a 10% drop from recent highs, is a normal part of any market cycle. It's not a crash, but it can certainly feel scary. These corrections often serve to shake out speculation and bring valuations back to more sustainable levels. So, is a market crash imminent? Let's look at some key indicators that analysts are watching closely. One major factor is inflation and interest rates. The Federal Reserve, or the Fed, has been the market's secret weapon, or perhaps its biggest influencer. For the past couple of years, they've been aggressively hiking rates to combat inflation. Now, the conversation has shifted. Will they cut rates, hold them steady, or pivot again? The Fed's decisions create ripples across the entire economy. When interest rates are high, borrowing becomes more expensive for companies, which can slow down growth. It also makes safer investments like bonds more attractive, potentially pulling money out of the stock market. This market madness, driven by every word from the Fed chair, is shaping your investments daily. Any sign of persistent inflation could force the Fed to keep rates higher for longer, which is a major headwind for stocks. Another indicator is corporate earnings. At the end of the day, a stock's price should reflect the company's underlying performance. We're in the middle of earnings season, and this is where we get a real look under the hood. Are companies still growing their profits? What are their forecasts for the future? We're seeing a bit of a mixed bag. Tech giants have been posting incredible numbers, which explains why investors are flocking to tech stocks. This isn't just a trend. Many see it as a new era of growth, powered by advancements in artificial intelligence, cloud computing, and more. But outside of big tech, the picture is less rosy for some sectors. Weak earnings reports or cautious guidance from major companies could signal broader economic trouble ahead. This brings us to navigating the stock market's stormy waters. Volatility seems to be the new normal. So how do you invest in these uncertain times? One key strategy is diversification. It sounds cliche, but it's more important than ever. Don't put all your eggs in one basket, especially not just in high-flying tech stocks. Spreading your investments across different sectors, like healthcare, consumer staples, and industrials, can help cushion your portfolio during downturns. Also, consider different asset classes, like bonds or even a small allocation to commodities, which can sometimes move in the opposite direction of stocks. Another strategy is to focus on quality. In a shaky market, companies with strong balance sheets, consistent cash flow, and a durable competitive advantage, what Warren Buffett calls a moat, tend to hold up much better. These are the businesses that can weather an economic storm without taking on too much debt or slashing their growth plans. It's about playing the long game instead of trying to time the market, which is nearly impossible. Let's break down today's stock trends a bit more. The good, the bad, and the opportunities. The good, as we've mentioned, is the incredible innovation happening in technology. The AI revolution is real, and it's creating massive opportunities for companies involved in everything from semiconductors to software. This is a long-term growth story that could continue for years. The bad is the persistent uncertainty. Geopolitical risks, ongoing inflation battles, and the potential for a consumer slowdown are all very real threats. This creates a challenging environment where stock prices can swing wildly based on the latest headline. But with challenges come opportunities. A market correction, while painful, can be a great chance for long-term investors to buy quality stocks at a discount. When everyone else is panicking, having a watch list of great companies you'd love to own at a cheaper price can be a powerful tool. Right now, some analysts are looking at sectors that have been beaten down. like renewable energy or certain consumer discretionary stocks, as potential turnaround plays. Now, let's zoom out and look at the future of the stock market with some predictions for 2026 and beyond. While no one has a crystal ball, there are some major themes that will likely shape the next decade. First, the green transition. The global push towards decarbonization will require trillions of dollars in investment. This could create a massive tailwind for companies in electric vehicles, battery technology, and clean energy infrastructure. Second, demographic shifts. Aging populations in developed countries will drive huge demand for healthcare services, from biotech and pharmaceuticals to medical devices and senior living facilities. Third, the continued digitalization of everything. The pandemic accelerated this trend, but it's far from over. E-commerce, fintech, and remote work tools will continue to evolve and capture a larger share of the economy. Of course, there are also hidden risks in today's market that every trader must know. One is concentration risk. The S&P 500's performance has become heavily dependent on just a handful of mega-cap tech stocks. If one or two of these giants were to falter, it could drag the entire market down with them. Another risk is debt. Both corporate and government debt levels are at historic highs. If interest rates stay elevated, servicing this debt becomes a major burden, potentially leading to defaults or a fiscal crisis. It's crucial to be aware that the market doesn't always go up in a straight line, and these underlying risks can surface when we least expect them. So, to wrap it all up, the stock market is at a fascinating crossroads. The bull run has been amazing, but we're facing a wall of worry with Fed policy, inflation, and geopolitical tensions. Volatility is likely here to stay. Your best defense is a solid strategy. Diversify, focus on high-quality companies, and maintain a long-term perspective. Keep an eye on the big trends like AI, the green transition, and healthcare, as they will likely be the growth engines of tomorrow. And remember, market downturns aren't just risks, they're also opportunities for those who are prepared. What are your thoughts on the market's future? Are you buying, selling, or holding? Let me know down in the comments. Thanks so much for watching. If you found this helpful, don't forget to hit that like button and subscribe for more deep dives into the world of investing. See you next time.